Hello everybody. In this series we're going to cover ideas that you could implement in your trading and things that you could potentially test when you're trading out of the zones. Now, I just want to preface this by saying these are just some really high level ideas. I know that many of you have your own experience, your own knowledge, and you probably have your own systems. So you would just take what you already have, apply the zones to your chart, and get to testing. I know testing isn't necessarily the funnest thing to do, but I personally love it because it enables you to see how a system behaves and determine whether that system fits your personality, which is very important when it comes to trading, because when you start losing money, which inevitably every system does at some point, you're going to be able to trade right through it. So what I have here is a random stock, Cisco. I have a daily chart converted to minutes. I am going to apply the buy sell zone. Come down to TBM buy sell zone. I'll just leave it at 500, but if you want to go, if you're going to be testing and need to go back in time, then you may want to put more zones in there. So let's go ahead and apply this. All right, so the whole purpose of this video is to give you some ideas on ways that you could potentially trade out of the zone. So I'm gonna start with honestly one of the most common that I've heard, which is stochastics. So I'm going to apply the stochastic. I have a personal favorite when it comes to stochastic. I like 10, 10, and 3. So now we have an indicator down here. So first, let me discuss, for those who are not familiar, what is divergence? Well, in its most simplistic form, divergence is when price is coming lower and stochastics comes down. I personally like to have the stochastic below my extreme, which is this line here. It's just marked at 20. You can change that. You don't have to have it at 20. I've done 25. Honestly, there's no set hard and fast rule to this, right? It's personal preference. You're going to hear people pretend that there's like magic numbers out there to use. I don't personally buy into that. Again, it's just my personal opinion. But you notice here how price is coming down, stochastic comes below the extreme. Price goes up, comes down again, and makes a new low. Actually, it makes a new low right here and here. You can see both instances stochastic is going higher, and I'm referring specifically to the orange line. In fact, you don't even have to, I don't even watch the blue line. So this is your divergence. Okay, just super simple. Price is making a equal or lower low, stochastic is going higher. This would be an entry point if you're trading this type of a system. And then you would just mark down the entry price of this trade and any kind of characteristics of the trade that you want to jot down, and you then mark the price that you would get out, and this would be a nice winning trade. So while we're on stochastic, that is how you measure stochastic divergence. I want to show you one other way to trade stochastic. Now, this one is just a basic stochastic cross, where your D line, which is the blue line, crosses the orange line. But the trick here is the cross happens below this extreme. So you can see, here's an example. Right here. And then we have another one here. And also, well, really it's this whole area. So I'm going to do that. So you can see here, there would have been a potential trade here. Now, I would have never entered that trade because I personally, once I have what I call a signal bar, I wait for a price to trade above that, the high of that signal bar. And you can see that never happens. And then we get another one here. And again, I would not have an entry. And then we get another one here. And then this one, we finally get an entry, but it doesn't happen until way over here. Okay. So let's go find a couple other examples. And then we'll wrap it up because that's all we need to discuss on stochastic. So here's another example of stochastic divergence. We have a low here, we have a low here, and you can see that stochastic does make a higher low while price is making a lower low. Again, you have it here. So really, it does happen a lot, which can be good and bad, right? At the end of the day, think about it this way, guys. When it comes to finding signals, in my opinion, less is more. We have a unique opportunity where there are 500 stocks in the S&P 500. They all have great volume. They are the largest stocks in the universe. We don't need a system that has a lot of trades. We need a system that just has good trades. So that's what I seek. That's why I do the testing. That's why I love market structure, because think about this. There's only so many market structure zones we're going to print in a given year on a given stock. We don't need to take every single one of them. We just need to have a couple. If we could get 2 trades per year per stock, we're crushing it, especially if they're good trades. I should say that if we can get 2 trades that are good trades and have a high probability of making a lot of money while losing a little bit of money, we're solid. Okay, so that wraps up this video. What we covered was stochastic divergence and a stochastic cross under the extreme. In the next video, we're going to talk about moving averages because that's also another popular method that people use for trading. I'll see you in the next video.